America. On the stock market, last Tuesday, the Federal Reserve Board raised short-term interest rates for the first time in 2 years. That sent shudders through Wall Street, and today the Dow Jones Industrial Average was down again 157 points. Our economics correspondent, Paul Salmon of WGBH Boston, looks at what makes the market move.
The stock market. Talk of its rapid 10-year rise may be getting as cliched as the footage so often used to depict it. But since some 43% of Americans now play the market, one question's on lots of lips these days. Are stocks irrationally high, thus headed for a fall?
How do we know when irrational exuberance has unduly escalated asset values, which then become subject to unexpected and prolonged contractions?
That was Federal Reserve Board Chairman Alan Greenspan last December, worried that if the market was significantly overpriced, it could suddenly drop, depressing both investors and the economy. And more recently, in a program called Betting on the Market, the PBS series Frontline documented exuberance that sure looked irrational to us.
It's got to go back up. It's got to. It was already up there. It's everything.
This is a neighborhood investment club, one of 10,000 formed in the U.S. last year.
We could get the Wall Street Journal and see what the high was, the
That's what Alice
52-week
said
high
last week, I think
and the
20.
low.
Sharon Gorney, a mother of 3 who owns a small carpet business with her husband, has put her entire life savings in the stock market, with a big chunk in shares of a tiny high-tech firm.
To tell you the truth, I don't even know the name of it. I know the call letters are AMLN. It's supposed to double by August.
Gorney's mother, Dorothy Free, also has all her money in the market, with less than 2 years till retirement.
If the stock market does drop, that's okay. It will go back up again. It has to, because the economy grows all the time.
Now, there's a classic economic debate lurking behind such investment clubs, as well as the usual stock footage. While you, I, and Alan Greenspan may wonder if the market is irrationally exuberant, many economists insist it can't be. Market prices are supposedly the collective best guess of rational investors putting their money where their minds are as to what stocks are actually worth at any given moment, in which case market prices are never irrational. In fact, we found an experiment in markets that suggests it can be totally rational to pay more than a stock seems worth, and still very dangerous. Caltech professor Charles Plott has invented a game showing that rational exuberance can also lead to a crash. And if it can happen in his lab, it could presumably happen in the real stock market any day. That pale blue line is the market price of a make-believe stock. It's a replay of Plott's experiment, as run recently with a group of very rational Caltech students.
These are not dummies. These people are trained. They understand how this works. They've done this type of thing before, but not this particular one.
Since we're showing you a replay, we can re-cue it to the beginning to go over the rules. On the computers in this very room, the students were about to make offers, as in any market, to buy and sell a make-believe stock. The better they did in the game, the more money they'd make, up to several $100s. Now, to keep things simple, and by the looks of this graphic, some might say simple-minded, think of what's being traded as stock in an oil company, with only one well. To give the game an end, it's being steadily depleted. And as it pumps, it pays the profits to shareholders in quarterly dividends. That diagonal line is the value of the company as it runs out of oil. So it should also be the average stock price. To make the game a little more like real life, there's a second diagonal showing the most that the company could ever be worth.
If the price of the oil was the highest possible, that would be the value of the payouts by the company. Beyond this is impossible, and everyone knows it's impossible.
Now, Professor Plott can show us exactly what happened, because every move in the market is recorded. Those purplish squares down below are orders to buy, as low as possible, of course. The green diamonds on top, orders to sell for as much as you can get. And those bluish-white circles in between?
The little blue circle is a trade. So those are actually the contracts that occur in the market.
Well, then that makes sense then, because the little blue circle is about halfway between the person who wants the most and the person who's willing to pay the least.
Oh, one more thing.
Now we're listening to the market.
To get a real feel for the market, Plot has put it to music. You can actually hear the prices from low to high as notes on a scale.
The high sounds you hear are the sell orders. As that's right. The low sounds that you hear are attempts to buy.
I'll buy at this price, I'll only buy at this price, I'll buy at this price, that's what...
Okay, before this explanation and music drives you to the kitchen, let's rerun the game and see what actually happened. Did investors trade conservatively, gradually lowering the price for the make-believe company as it pumped its oil and lost value? That is, did the price drop along the first diagonal, as economic theory would predict? Nope, not a chance. The price stayed high.
Which is a strange phenomenon. That means that these buyers are buying at a price that they know and everyone knows is greater than the fundamental values.
Let's listen to it for a second. Oh wait, here's some skeptics down there.
That's a fascinating phenomenon. That's a sign of a market getting nervous. These are people who are basically saying, this is crazy. I'm not going to participate. I'm afraid to participate. And you can hear them actually sending in their buy orders low.
Yeah, but up here, everything's really happening up there.
Everything's happening up there. These aren't actually trades here. These are just orders that are coming in that would only be seen by somebody who was there at the market. You don't see this.
Because all we'd actually see in the daily ticker tape or a chart of this particular stock
is there, the price.
This line coming right across,
Just coming across.
It was the high prices everyone's seeing these days in the real market, and the idea that such exuberance is justified, that caused Alan Greenspan to conclude congressional testimony in February with another warning.
In short, history counsels caution.
Other economists, meanwhile, like Martin Feldstein, have remained sanguine throughout.
I would say that the long-run record and everything we know about the underpinnings of the stock market tell us that it's going to outperform the alternatives for anybody whose horizon is not a year or 2 or 5 years, but longer than that.
A recent hot seller, Stocks for the Long Run, makes the case in rose-colored detail. Over the last 2 centuries, U.S. stocks as a whole have returned on average more than 10% a year. Safe bonds, by contrast, have returned less than 5%. So stocks do seem better in the long run, and in the short run there are reasons aplenty to justify their high prices. Low inflation, high corporate profits, baby boomers saving for retirement, the coming infusion, perhaps, of Social Security funds. Back in the lab, however, there are no such reasons for optimism. Yet, as the game marched on, so did the stock price of our make-believe company, staying well above its expected value, making its way toward the maximum price set by the rules of the game.
Here's a guy who just asked for more than the stock could possibly be worth.
Andy, listen to the market. It's telling you it's crazy.
That is, those dark low notes are increasing.
But now we've broken through the absolute maximum.
Everyone knows that this is higher, but listen to the nervousness.
More low notes, more low bids, more nervousness. Now, this is just a game, but why is it much different than you or me putting all our retirement money in mutual funds, even though we keep hearing that stocks are near or above all-time highs? Finance professor Tzvi Bodie is no prophet of doom, but he thinks we investors don't realize the risks we're taking.
One of the things you hear is that if you buy shares in a broadly diversified portfolio of stocks, as is offered by a mutual fund company.
Lots of different companies.
Lots of different company stocks, that somehow that eliminates the risk. But even in that broadly diversified stock portfolio, there's an awful lot of what we call market risk. That is to say, risk associated with the stock market as a whole. And there have been years when many years, when the stock market has gone down more than 20% in 1 year. The broad stock market.
The point, says Bodie, is that 20% drop, repeated a few years in a row, could stagger your savings for the foreseeable future. And as a retiree, you might not have all that much future to foresee. Consider the Japanese stock market for a moment. In 1989, it almost hit 39,000. Today, it's around 18,000, an annual decrease of nearly 10% a year for most of a decade. Or suppose you'd retired in the U.S. in 1929 at age 65, invested in U.S. stocks. They didn't regain their pre-depression value until 1954, when you'd have been about 90.
Somebody listening to this is going to say, he's got to rely on the Great Depression to come up with an argument. Well, that's fine. That can happen. But X out the Great Depression. Forget that. What about somebody who retired in 1973 when the market collapsed by, 40% in 1 year, and finds out that he has a heck of a lot less than he thought he was going to have to enjoy a comfortable retirement? Could that happen again? Sure, it could happen again.
It could happen if stocks today are way overpriced. And that, of course, is the whole point of this experiment. Are even the most rational investors liable to overpay? Well, here's the game in fast forward. The stock price holding up after each dividend, those vertical dotted lines, when by all rights it should have been dropping. What on earth was going on?
Well, if I think that there are idiots there, and I can buy here and sell here for the same price, I get the dividend for nothing.
You mean each time that you got that dotted green line, you get some payout?
You get some payout, so if I own it overnight, I get the payout. So if I can buy it here, get the payoff overnight, sell it here for the same price, I make money.
But these are no dummies. These are Cal-Tech students who know exactly what's going on.
No one in this experiment's a fool. They just don't know that no one's a fool.
This is sometimes called the greater fool theory. That is, you're no fool for paying an astronomical price, so long as you have reason to believe there's someone else, called the greater fool, willing to pay even more. In fact, you could say this is turning out to be the punchline of the experiment and moral of this story. It's rational for any given individual to pay too much as long as others will. But that just makes the market as a whole more and more vulnerable to a sudden and massive change of heart. Now listen for lots of low notes, a sign that opinion is shifting.
I'll buy at this low price. I'll buy. No takers. Uh-oh.
The green diamonds are sellers dropping their price. The circles are the trades back down to what the company's really worth.
The correction is sudden and dramatic.
Listen. No. That's what. God.
That's it. There's no such thing as getting out of these markets on the way down.
So is this the fate that awaits the U.S. stock market in 1997? Well, frankly, who's to say? There is no artificial end point the day the U.S. corporate well runs dry. And even if fundamentals like earnings and inflation were to turn sour, if enough investors continued to believe that they had no good alternative for their money, then prices could stay aloft, theoretically, forever. On the other hand, its recent drops might suggest the stock market is already singing a different tune. Is real-life exuberance, whether rational or irrational, fading as fast as it did in our game? Unfortunately, that's only possible to say long after it's already happened.